All right. Awesome. Thanks, guys, everybody, for coming. Got a great turnout today, so I appreciate that a lot. It's always nice to see a lot of faces smiling back up at me. For all our returners, thanks again for coming back. Must mean we're doing something well, so it's always good to see. For anybody that's new, thank you for coming. My name is Chris Krenzig. I'm one of the people hosting it. The other one is John Cohen, who is late. Very atypical of him, but we'll forgive him this time. We both work for Toro. We're multifamily focused. We've acquired over 3,000 units in the past several years. That's kind of our bread and butter. That's what we do. But we do have some experience in. Just turn that down a little. Sorry. In other areas, tax deeds, land, mobile home parks, etc. So we're here as a resource for you guys. The way we're going to structure today, this is Sonya Rocvil. She's graciously agreed to join us and give us some of her insight. She's also in the multifamily space and some other things, but she's really going to talk today about partnerships, joint ventures, how to build a team out of state so that you don't run into some of the same mistakes that we've made. After she's done with her presentation, myself and or John, if he decides to show up, are also kind of going to do a little panel, ask a couple questions, give some answers on what we think, and then we're really going to open it up for Q&A. So if you can, I ask you to try to keep your questions till the end. We are recording everything. The reason being, we put it up on YouTube. We thought, we've been doing this for 2.5, 3 years, give or take. We really should have started recording these a long time ago. I know a couple people have watched them already, so we want to make it available to everyone that we can. Because I don't feel like running around with a mic, I will repeat the question that everybody asks. So if you do it at the end, it just makes my life a lot easier. But if you do have a question that you feel is really important at the time, it is okay. No one's going to kick you out or anything. But if you can, please do wait for the end. So without further ado, I'm going to hand the mic off to Sonya. She's going to introduce herself and tell you more about what we want to talk about.
Thank you so much, Chris, and welcome. And thank you, everyone, for coming today. It's great to see all of you here. As Chris mentioned, my name is Sonya Rocvil, and I am the principal and founder of my company, BedRock Real Enterprises. My journey to real estate was probably pretty atypical. I started out my career in accounting and audit. I did financial statement audits and got a CPA license, and then transitioned into financial services, and I spent most of my career in financial services. All the while being in New York, being surrounded by real estate because it's everywhere. I definitely caught the real estate bug. Also reading Rich Dad, Poor Dad books, probably like a lot of you, but never really knew how I was going to get into real estate investing. And then in 2013, everything really changed for me. The company that I was working at, the role that I had was going away. My whole team was completely disbanded. And it was a really critical point where I thought, okay, do I find another role in financial services, or maybe I can try out this real estate thing a bit? So that's what I did. I joined several organizations, and one of them was a multifamily investing group, and they were doing something that I wanted to do. They were investing in apartment buildings, but New York was just so astronomical in prices that, I thought it was a great strategy that they had of investing outside of New York. So that's what I do. I started out first by investing passively in other people's deals. And that helped me because it helped to just give a little bit of credibility. When I started talking to brokers in other markets, I could say, I'm an equity partner, I'm a partner in multifamily deals. And I could talk a bit about those deals. So it gave me a little bit of confidence, and I was able to begin to develop those relationships. And in 2014, I sponsored my first deal through a joint venture. It was a 48-unit apartment building in Atlanta. And my joint venture partner was somebody that I met in one of the multifamily groups. Probably somebody sitting next to you right now could be your next joint venture partner. And through that, our partnership grew. And we have three deals in the Atlanta market that we ultimately bought. over 200 units in Atlanta, and through passive investments. In total, I made investments in over 700 units over this period of time. So today, I'm excited to talk to you about partnerships and joint ventures and how you can use those to build your business. So I think we want to go to the next slide, Chris. And the next slide again. And one more. Okay, great. So these are just the photos of the joint venture deals that we have in the Atlanta market. The first one was the 48 unit that I mentioned that we purchased in 2014. We actually sold it a year and a half later. And we did very, very well on that deal. The second deal, Snapwoods, we purchased in that same year in 2016. We're actually in contract to sell right now. That projected ROI was at the time when we were making the investment. We actually are expecting when we close in the next shortly for that ROI to be higher than that. And then our most recent acquisition, and that was a 56 unit. And our most recent acquisition was in the end of 2018. It's a 174 unit property, also in Atlanta, and we have a long-term hold horizon for that one. Okay, so just in thinking about partnerships and joint ventures and just real estate in general, as you probably already know, real estate is a very relationship-oriented business. You're building relationships with the people that you're working with, the brokers that you're in touch with that are helping you find the deals, the people that are helping you manage your property. It's very relationship-based. So, and that's the core of real estate. So when you think about partnerships and getting into a joint venture, you think about it first as a relationship that you're developing and building. Before you start getting into these partnerships, you really want to think about what is your investment strategy. Everybody's strategy is very different. You might be a single family buy or hold, or a fix and flip, or you may be focused on smaller multifamily units or larger multifamily. So you want to make sure that the types of properties that you're interested in align with all of the people that you're going to be working with. That could be a potential partner. That could also be the property manager. You may decide, for example, in multifamily, some of the decisions that we have to make are we going to be looking at A class or B class or C class properties? What neighborhoods are those in? Would we find the best property manager to manage in those neighborhoods? Because some property managers are better at the brand new properties, the brand new with highest amenities, while others are better with working class residents. So you always have to look for that right fit. When you're also looking for partnerships, you want to do your due diligence in with your partners. So in other words, understand again what their strategy is, make sure you're clear on your own strategy, and then you understand the track record of the people and vendors that you're working with as well, because that's going to be critical for you in your rollout plan for your own success. And another key thing when you're looking at joint ventures is to make sure that you outline the roles and responsibilities. So it's very clear who's going to be working on what parts of the deal. And it's always better to do that in the beginning when everything is working well versus later on when things may not be working the way you thought they'd be. So it's better to have those things outlined in the beginning. So let's talk a little bit more. I've been saying the term joint venture. What does that really mean? So a joint venture it's an agreement where you have two or more groups of people who come together to do or to work on a particular deal or a project, but they still keep their own individual entities. So let's say that you and I were in a joint venture. You would have your own company, I would have my own company, and then we would form another entity to purchase a property, let's say to purchase a multifamily deal. But you, at the end of the day, you still have your own company and I still have my own company. We're working on this particular deal together. And you can do those joint ventures for one deal. You could do them for 1,000 deals. You can really just, it allows you to have flexibility in the deals that you're doing. If that makes sense. Okay. So sometimes people ask, why do you do a joint venture? And there's a lot of different reasons for that. I remember when I started out and I was looking at multifamily properties, at first I thought, well, I think I'm going to start doing this on my own. I'm just going to work on it by myself. So I'll probably start out with a 10-unit property or maybe like a 8-unit property, something more manageable for me. But one of the key advantages of working with other people is that you can expand your resources. Once you have more people, you have a larger balance sheet amongst all of you. In other words, you have more cash amongst you to be able to do the transaction and to do the deal. You have better economies of scale. People are bringing in the different knowledge bases, so you can work with people who complement your skill set. So maybe you're awesome at analyzing deals, but you're not as good with when the deals actually come on board and you're trying to manage them to perform well. So it's great to have somebody who has a complementary skill set that can help you with that. Joint ventures allow you to go bigger. So for me, when I first started, I was really thinking about, like I mentioned, the smaller 10-unit property. But because I was able to do the joint venture with my JV partner, we ended up doing my first deal as a sponsor was a 48-unit. And that was because we had more resources and ability to do that, more than just me and myself. I was mentioning capital, and I was mentioning your balance sheet and net worth. That's a very important thing because as you start looking at larger size deals, the lenders are looking at your net assets and how much you have in net assets, and they want to make sure that you have a certain amount of net assets as it relates to the loan that you're taking out. So when you have more people on your team, that means that you can look for larger deals, and you have a larger range that you can take down, if you will. And like I was mentioning earlier, expertise is really good. Another reason people do that. Sometimes you could have situations where maybe you have a lot of the money or capital, but you don't know how to actually execute the deal. Or maybe you're somebody who decides that you want to passively invest, so you want to find somebody who you can just identify a deal that you like and you feel comfortable with and then invest with them. So, you're able to leverage more and you're expanding beyond yourself. So for me, I found that extremely valuable, and also I like working on teams. So that really helped, that really broadened my thought process of what types of deals I could actually do. Okay. So just thinking more about, I just wanted to delve a little bit more into why you are doing a joint venture and just some of the things that you need to think about. So one of them is your investment criteria. I was mentioning before that you really need to think about the types of real estate deals that you're interested in, and you have to know that very well, because there may be some people who are interested in, for example, in multifamily. You can look for deals that are generating cash flow, monthly cash flow, while there could be other types of deals that are more that you won't have cash flow for maybe the first year or so, because they're heavily construction based, and you're buying them at a lower price so that you can essentially sell it later or flip it at another point in time. So you're not going to have any cash flow. So it's important to understand what your criteria is, so you can align that with the partners that you're meeting and seeking out. The other thing is determining your target market. Again, for me, I knew that investing in the East up here in the East Coast was going to be a challenge, just from a capital perspective, and also landlord-tenant laws was something that I thought about. So that's why our deals were really focused more in the Southeast than in Georgia, because they were more favorable for the landlord. And then in your joint ventures, you want to really clearly define the roles and responsibilities. So understanding who's going to be doing what. For example, who's going to be responsible for the market analysis, understanding the area where you're investing, or also who's going to be analyzing the deals. Maybe depending on how many people you have in your group, you may have more than one person analyzing deals, or you may just have one person who's really focused on just having the relationships with the brokers and analyzing the deals so that you can determine which ones you want to move forward with. Then there's the due diligence process, where at that point you may have had a signed contract, and what you're going to do is start verifying that everything that you thought, that your initial assumptions about the property are accurate. So you have to determine who's going to be doing that part of the process, or how you're going to divvy up that work. And then you have asset management. So once you bring the property on board, you want to make sure that it's performing the way that you projected, or its in the highest possible way. So there may be one person who may be more focused on the asset management once you have the property versus another. And then also, of course, there's investor relations. So if you are going to be syndicating deals, which means you're going to be bringing on other people to invest with you, you need to have someone who's managing that relationship first, managing those relationships first with the investor, onboarding them to be part of the investment, and then also keeping them updated on a regular basis so they understand how the property is performing. Those are all very important things. And then when you have a joint venture and you have more than just you're able to divide up all of these roles more amongst you. So it makes it a lot easier to do that. Okay. So on this last slide here, everything that I was talking about before in terms of joint ventures and the people that you're working with on your own team would also apply to your real estate team, especially if you're working outside of your local area. So in terms of a property manager, you also want to be able to do your due diligence on your property manager, make sure that they are the right fit for the type of property that you have. If you have a smaller size property, a medium or large property, you want to get the right property manager that's familiar with that size asset to help you work with that property and to optimize it. Very often, what happens is you can have a mismatch, and you may try to get a property manager that may be too small for your size property, and they don't have the systems and controls and reporting in place to really help manage the property the most effective way.
Sonya, can you just read them
Sure. Okay. Yeah. These may be a little small. Okay. Yep. So the circle here is, so I was talking about the property manager, your real estate broker, lender, your legal person, CPA, and your investors. So those are all of the people that are really going to be core in your team. And some you're going to be working with on a day-to-day basis, like the property manager, while there are others that you work with during a period of time. The next one I will talk about is your real estate broker and building a relationship with that. So over a period of time, you're going to be talking to, and when you find your market and you start identifying brokers, multiple brokers in that area, you're going to start building a rapport with them. They're going to help you to identify properties, especially in this market that overall many of the markets right now it's really a seller's market. So most people are selling their deals through a broker. They're going to be your path to acquiring a property. So you, from having that relationship with the broker, you'll be able to learn about your area more. They'll be able to give you insight into the area, as will your property manager, and you can actually use the relationships with your property manager and your broker to sort of double check to make sure that things are being that things are accurate. So for example, sometimes it happens, a broker may say, oh, this is a really great area, low crime, etc. And then you talk to your property manager and they're like, okay, but there were really like 5 shootings at that property last month. Like they may know some additional information that, you know, may not necessarily come up with the broker sometimes. So it's a good way to double check, you know, what's actually happening. And remember, your property manager, they're your feet on the ground. They're the ones that are going to be there day to day. And they're the ones that you're going to show your pro forma or your income projections to, and verify with them like, hey, this is how I'm expecting this property to perform. I need you to help me work through that, and they'll be able to vet your assumptions. So, you know, those two relationships, those are your on-the-ground market relationships. Those are critical. Then there's, of course, the lender. So, while you are in the process you're in contract with your property, you'll need to reach out and have a lender team who will be able to help determine how much financing you'll be able to get. A lot of that also depends on the strategy that you have and the type of property. You may buy a building that needs minimal work, and that you'll be able to raise most of the funds from your investors to do that work, and you're really just getting a loan for the value of the property. But then there may be times when the property has very low vacancy or needs a lot of repairs, and you may need to get a different type of financing for that. So depending on the strategy and the type of property that you have, your lender will be able to come up with different types of financing for you. Your legal team, of course, is critical. They're going to be helping you with your contract, you getting into contract. And then if you're syndicating deals and you're getting outside money, you want to have a legal team that's going to help put together the documents that are needed for that. There are a lot of SEC requirements and formal legal documents that are needed, and they'll be your guidance in getting those done. Your CPA team, they're going to help you. Ours help us in the beginning with contract negotiation, with outlining the value of the property and stating that in the contract, allocating it for tax reasons. So they're your tax guides, and they're going to be preparing the tax forms for you and for your investors every year. So you definitely want to have a good team that's familiar with multifamily that will, or whatever types of property that you have, that will be able to guide that to get the best tax situation for you and for your investors. And finally, last but definitely not least, are your investors. They're your partners too. These are people that are entrusting you with their funds to manage for them. So it's critical that you're constantly in communication with them, keeping them abreast of what's happening on the property, and also working with them so that they can have the best experience working with you. So that was just an overview of the teams, building a team, some of the things that you need to consider when you're looking at joint ventures. And I think at this point, if there are any questions, I'd be happy to take them.
Well, I think what we're going to do now. So all we're going to do now
she's awesome.
is I wrote down a couple questions while she was talking that I think might be good questions to have. We can kind of discuss, maybe 3, 4, 5 questions, see how it goes, 5, 10, 15 minutes, and then, we're going to open it up for questions. So I think, one of the more important questions I think that a lot of people have is, why should I do a joint venture over, forming a company with someone and creating something permanent that maybe could lead to, a nice business down the line? Why would I choose a joint venture? Sonya, you want to start it off?
Yeah.
Can you just talk into it a little bit more?
Okay. So, my preference for the joint venture is the fact that it just gives you a bit more flexibility with the relationship. So, like I was saying, you can decide to work on one project with that other entity or that other group of people, or you can have multiple projects with them, and you both or all still have your own separate companies. So if it turns out that maybe one of the joint venture partners also, you have one strategy together, but then they may also want to use their company to do other types of ventures. They also, so you're investing in multifamily together, but maybe they also want to do like fix and flip. So it gives them that flexibility to not be locked into a particular type of, deal type with you. You're able to kind of farm out and do other things. And then also, if if things aren't going exactly well, then you'll be able to know that you just have that one project together. Whereas if you had joined and had a corporation, you're going to have to, get a formal resolution to break out the company and break that person out, and it's just a lot more legal work that's required to separate you from that group.
Okay, John?
Yeah, I would say, how many people here are married, right? You don't marry your wife or husband the day you meet them. Most people, some people do. But you date before you marry each other, right? You could have visions aligned today, but, if your partnership, if it splits or maybe something changes, you have significantly more flexibility. So that's the major reason. Sonya touched on it. You just have the flexibility and creativity to go off and do your own thing, or maybe you guys just end up getting along perfectly and you can do 100 deals together. But you crawl before you walk.
So I think it's actually kind of interesting as I'm thinking about it. Sonya, you really haven't created a formal partnership, but you have several joint ventures with the same people, right?
Yeah.
And John, you obviously started with Don on a couple, call them joint ventures, but now you guys form Toro together. I'm really curious to hear, Sonya, why you haven't, made the transition over. And John, at what point did you reach that you thought it was a better idea to kind of formalize it into a full company? So Sonya, why haven't you made that step over? Why have you kept things as a joint venture despite having several deals with the same people?
Yeah, well, one of the things is the company that my partners have, in addition to doing multifamily, they also are doing they also do single families as well. So we've just decided that it made sense to keep our companies separate, because while we are focused on on multifamily together, there's still another part of their business that they're managing. So
Gotcha.
for us, it made sense to keep it this way.
And
Yeah.
John, just on top of it, how many joint ventures or whatever you want to call them did you do? And then, I repeated the question.
Yeah, so the way we started was my partner didn't want to do smaller deals. He just had no interest in it. He thought that, the smaller, it didn't make sense. He wanted to do, 200, 150, 300 units plus. So out of the box, we saw opportunity. The first deal I did was 48 units, and I didn't even know him at that point, but he had no interest in the smaller deals. So it sort of started that way. But when we met each other, we were just at points in our life where he was looking for someone younger that could work and do a lot of the work. And he had capital, he had a balance sheet, so it was a good mix. I didn't want to just dive in head first with a partnership because I didn't know how we'd get along. So we did 3 deals, I think, with mostly his money. By the third one, and even the second one, actually a deal that Sonya's in, I raised part of the capital. He put in a lion's share of the capital, and it allowed me to get to a point that was different, and it brought me into a different space. And then simultaneously, it allowed him to quit his job. He was working at Cushman Wakefield. So it was just a good marriage, but we waited a long time. The first deal we did was in 2015, and we didn't incorporate, for quite some time after that. So, and we knew each other even prior to that. So it was just, he had a different vision on the business than I did, but he saw me as an asset. I saw him as an asset. So we did a couple deals together, and then we came together. Simultaneously, he's also very opportunistic, where sort of what I say goes. Not that, he would disagree, but if I have an idea, he's very flexible. We could go buy, a retail center tomorrow, or we could buy a multifamily property in Alabama. He's gonna listen to me. So it works very well where, if I have an idea, he's willing to listen. He's very opportunistic, as am I, which is where we got along really well. And we just get along very well. Some days, yes, I might not see eye to eye, and Chris works in the office every day, but
Some days or most days?
yeah, most days. There's some days where it's like, what's he doing? And then lo and behold, we're $2 million short on a deal. He picks up the phone, calls 3 friends, and it's raised, we close, no questions asked. So it goes really well, and I saw him as someone that I can, he's a little wild if you don't know him, so I was able to tame him a little bit. And it's worked out really well.
Don't let him hear that. He's going to start fighting back.
Yeah, no, he actually says that, he loves when I'm wrong, so he can rub it in my face. But no, it works out well. We get along great, and it just was a really good relationship where I was in my life at that time. Without him, I'm not here today doing what I've done. Or maybe I am, but he's been, gasoline to the fire. So if you find that person and it really is helpful, obviously do it. But simultaneously with that, Toro is not, it's 50-50 owned, 50-50 JC Property Group and MDCD Partners. So even as its own structured company, it still is our own entities involved. And, we've done deals, he bought a coffee business in the city with him and 3 of his friends. I'm not involved. Simultaneously, we've done some stuff. We have a deal in Jacksonville. He's not involved. And we're completely open about everything, and we speak about everything. Hey, you want to do it? No problem. I'm going to. So we have a pretty flexible partnership. So it works out really well.
Mm-hmm. Changing gears slightly, if you were thinking about doing a joint venture for the first time, maybe you think I can do something bigger with somebody else, or maybe I don't have the capability to do it myself, or maybe you just like working with somebody. What are things that you looked for when you were choosing your partners, and what are some things that maybe you would look for now that are different, knowing what you do now, going through what you've gone? What are some things you would look for in somebody else as you were thinking about entering a joint venture?
I would say from my standpoint, making sure the visions align starting, right? I know Sonya spoke about it briefly before, but, if you're zigging and I'm zagging, we're never going to get along. Out of the box, what are you looking to accomplish? Mm-hmm. That's something that, we were on the same page out of the box. We basically had the exact same goal immediately. So that was a level playing field where if I wanted to fix and flip houses and Sonya wanted to buy multifamily, it may not work. It may work. Hey, I'll focus on the multifamily, you focus on the fix and flip or whatever, and we can build a bigger business. But I would say out of the box, just, outline what you're looking for, have the person that you want to partner with, outline what they're looking for. If it's apples and oranges on every single box, it probably won't work, or you have to structure something differently. So I would say definitely understand who you're going into business with, because I think that's more important than anything, knowing that, if it goes a little sideways, they're going to roll up their sleeves and get dirty. That, you want that person in your corner, not someone that's just going to bail and, throw the towel. And I think that's where we've done really well, where, we've had some situations that, without Don, maybe I don't do that deal, but we've been able to, right the ship pretty, quickly. And I think that's super important.
Yeah, I agree with that. And, just expanding on that, I would also just say having a very similar value system. Some of the things that are really important is, first and foremost, making sure that we're taking care of our investors. That's the most important thing, protecting our investors. And for me, I want to work with somebody who always has that on top of mind. So it really drives every decision that you make in terms of like where you're doing the deals, who's managing the property, how the property is performing, what are we doing for returns, how are we updating investors. These are all things that have to be core for us to be able to work together well, because that's the driver, that's the foundation. So I would say like values and then understanding strategy.
Just to add on top of that, another part of it, would you look for somebody or people that look at, not necessarily, the alignment of interest? I think you would both agree, but in other things, maybe, strengths and weaknesses. Would you look for somebody that complements your strengths? Would you look for somebody that has different strengths than you? Would you look for somebody that, do you want somebody that views deals the same way as you? Maybe you're aggressive and very opportunistic. Do you want somebody that looks the other way to kind of balance you out? Or do you want somebody that looks at stuff the same way, so you guys are both going in the same direction together? Things of that nature. What type of blend did you guys look for? Would you look for in terms of, your strengths, how you look at investments, deals, markets, etc.?
Well, for me, just because of my background as an accountant, I tend to be a lot more conservative than maybe my partners are. But I think it's good because we balance each other out. But at the same time, they're not like, cowboy aggressive. They're just a little bit more,
so they pull it out of you a little bit.
I know the partners, and one of them called me. He's like, this might not fly for Sonya and Krista, but can we do something? I'm like, I don't know. I know they're going to be on the complete opposite side, but.
But I think it's a good balance though, because there may be deals. I think when especially when you start looking at so many deals, I know that there are deals that we probably would have not pursued, and it was good that we did go down that path. We may not have gotten them, but it was good that we went down that path. And there were other deals that we stayed away from. So I think it helps to have the balance.
So you're saying that if you were alone versus with them, you would have passed on deals that could have ended up or did not end up being good because you fear you would have been too conservative?
Yeah, I might have been too conservative, in underwriting it, and then there may have been deals that we would not have pursued, and we have only a certain number of deals that we did actually get. So, but I think it's important to have the pursuit, because that's how you learn, and that's how you build up your relationships, by having that constant dialogue with the brokers and giving them feedback, and then giving you feedback, and also working with your property manager as well. So it actually going in and getting your hands dirty and analyzing the deals and moving forward, actually it helps to build your rapport, and it helps to build your skill set, and it helps to build your team.
Yeah, 100%. I mean, there are deals. So I wouldn't partner with someone that was exactly like me, because it'd be mayhem, right? I am completely on one side and my partner's on the other. So Give me the back of the napkin and I can get pretty close. And my partner will dive significantly deeper into a spreadsheet and build it out. If we were both just building spreadsheets for every deal, we probably wouldn't even be competitive on any of them. There are some times where, he spends, weekends building a spreadsheet and it comes out to the exact same number as the back of the envelope. But having that balance knows that, if I did make a mistake, he's going to catch it where, maybe it wouldn't have been. So I say, having a partner or a joint venture partner or someone you're working with that, is the opposite or can counterbalance you is super important. If you're both glass half full, who knows what's going to happen? If you have someone taking the other side of the coin, it can't hurt, right? You're going to have a conversation, and taking another set of eyes and having someone else look at the deal is only going to benefit it, getting another perspective on it. So I think that, having, different personalities helps, but you got to make sure those personalities can work together with each other. That's more important than being complete opposites. Opposites do work, but you got to make sure that early on.
Mm-hmm.
Right.
Switching gears, did you have something to add or no?
Oh, no,
Okay.
I think that's great.
Switching gears a little bit just to go to team building, because I want to touch on that and then we'll open it up. If I am somebody that is looking to enter a market or to start building a team, whether it's a market out of state, a market close by, and I want to build that team of, people you covered, Sonya, a lender, a property manager if I want to use one, I forget some of the other ones, a broker, accounting, legal. What is the first step? Where should I start? Who do you think is the most important? And who can I leverage to find other resources?
Yeah, so if you're going into a new market, I would say that your first step is, one of the things that we actually did was we started looking at deals in a market, and we were liking the deals that we were underwriting. But then we couldn't find a property manager in that market that we thought would be able to manage those deals well. So what ended up happening was we spent a lot of time trying to understand this market and working with the real estate brokers, and they were all helpful, but we ended up not moving forward with any deal in that market, but just because we couldn't find good property manager. So what I would say is, find the markets that you think make sense from the perspective of where you're seeing opportunities for population growth and job growth. Narrow in and find those markets and look for the brokers, but simultaneously you really have to have a good property management team in place as well, because they're the ones that are going to help you day to day with making sure that the property is operating efficiently. And if you find one property manager, that's okay, but you really need to have like 2 or 3, because if it doesn't work out with that one property manager and that relationship doesn't go well anymore, you don't want to be in a market where you really only vetted one person or one company and they're the only company there and you don't have other options. So I would say it's a little simultaneous with the broker and the property manager, but you definitely need to make sure that you have a good property manager.
100%. The hardest relationship to manage in this business is the guy that comes in second place for management, because you obviously didn't pick him, but he was good enough to get the runner-up. If your manager fails, who's gonna take over? Who's gonna help? So that relationship is very difficult. But like Sonya said, to piggyback off of that, your management team is by far the most critical piece, in my opinion, in the business. We've completely changed it. We've been very opportunistic. We've bought some deals in some areas that I wouldn't buy again. We've done very well on them. But we've shifted our strategy to where our 2 strongest management teams are: Jacksonville, Florida, and Columbus, Ohio, because our managers are phenomenal. They've done an amazing job. They're great. We get along. We see deals the same way. So, 4 years later, we fired managers. We've had, don't be afraid to fire your manager either, because next thing you know, the wheels are off the bus, and now you got to pick up the pieces. If you think something's wrong, fire them immediately. But we've gravitated and we've built our business plan around not only good market fundamentals, but a really good team. Because you can have a really good team in a market, and you'll outperform. If the market's doing great, anyone can do well there. It's when the market's not doing well or something's going wrong, the right team will fix that problem. So, we've built our 2018 going forward plan, around acquiring 2,500 units in 2 major markets where our teams are really strong. So, Sonya's 100% right. You can underwrite 1,000 deals in a market. If you don't have anyone there that can do it and help you with the heavy lift, unless you plan on doing it yourself, that market's not going to work. So management's super important. And I think the other thing that we do, I know in particular Atlanta, we don't own anything in. I'm an investor in a deal, but that's irrelevant. We just got 2 deals that sent us in Atlanta the other day. The first thing I did was call one of Sonya's partners, and I said, hey, why am I going to bang my head against the wall trying to figure this out and compete? Is it a good deal or a bad deal? Now, they own in Atlanta. You guys own quite a few properties in Atlanta. He didn't see these deals. So a broker sent it to me, which was nice. I sent it to him, and he gave me feedback instantaneously. I was able to go right back to the broker and just say, hey, this one's not going to work. We'll dig on this one, but, we're still far off. So having relationships with people that are in markets, whether it's the management, the broker, legal, accounting, whatever it is, also knowing people doing business there is important because we're not there. We're not, we have no interest in Atlanta. Not that it's not a good market, it's super competitive, but they own quite a few units there. So I know that we get along great. We've done deals together. Krista, we had a deal together in Alabama. Chris, I've never done a deal with. Sonya's an investor of ours, and I trust 100%. I have all the confidence in the world in bringing that deal to them, saying, hey, what do you think? Is it a good deal or not? Let's partner on it, because I know we all bring things to the table that work. So, yes, you can do this on your own by yourself, but if you have someone that owns a deal somewhere and you know that they are operating there and they've been successful there, don't, be collaborative, right? You may say, hey, can you take a look at this? We're not going to partner, but I would like someone else's opinion. Be honest, but, there's no point in cutting off your nose to spite your face, right? If you're collaborative, and part of why we do this is to bring people together so we can make introductions and people could do business together, but, don't be afraid to reach out to someone working there. That's something that we do all the time. If we're not in a market and we get a good deal, I'll go right to my contacts and say, who do I know there that I trust? Same thing in Houston. I called a buddy of mine who owns, 1,500 units in Texas. He introduced me to his manager and so on and so forth. So that, to me, is more important than anything. Finding a deal is great. If you can't execute on that deal, you're wasting your time. Right. So having good teams in place, joint venture partners, opportunistic people that you can work with is more important than anything. So I would say finding the people in the markets that you can work with is the first and definitely the first thing I would look for. Places where you want to be and where you can execute on, because you can find the best deal in the world. If it's in, blah, 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 Mississippi, and it takes you, 18 hours to get there, and you have nobody there, what are you doing, right? It could be a 30% return, it could be 100% return. I'm probably not going to look at it because it's irrelevant for me to be there.
Yeah. All good points. Just to kind of add to it as well. Just for somebody that's looking to enter a new market, I think the easiest place to start on a blank slate is brokers and agents, right? It's their job to market to the public, so their name is out there and you can use them as a resource to leverage other people. Their job is to know the area, so they're going to know the properties, they're going to know the property managers, they're going to know the people that did the lending on the last 5 deals that have sold. They're going to know probably who did the insurance. They've looked at, when they sold that deal, they looked at the insurance provider. So if you're entering a market and you want to use people that have done business in that market, which I would encourage you to use, you don't want to use a lender that's only done deals in California and you're buying in Mississippi. It might work, might not. The agents, the brokers, it's their job to be out there and be known. So use them as a resource to find other people. Talk to 7 agents or brokers. Ask them who are good property managers. They'll probably give you 2, 3, 4, or 5. You'll probably have 2 or 3 that pop up a couple times. Go call them and start there. Then what I would do, call the properties or the listings in the area. Somebody picks up the phone to say, hey, I want a lease. Ask if they're the owner. If they're not, ask if they're a management company. If they are, ask who they are. Call 50 listings in the area. See who manages a lot of deals in that area. Great way, to find, the management companies. From those 2, you can pretty much relay into the other areas, lenders, insurance, What were the other ones that were on that board? I forget.
You have
Legal.
Yeah.
Yeah.
And the investors.
Yeah. So you can use those two to leverage, but the easiest people to find are usually, the agents and the brokers, because that's their job. Last question, and then we'll open it up. What are some of the downsides to a joint venture that you might see? If there is any, in your opinion. It could be you don't really see any, but is there anything you should know about going into it, or any ways that it could go sour if you don't do, something up front? I know you spoke about, Sonya, detailing out the roles and responsibilities, so something like that maybe. Is there any downsides, and is there any potential pitfalls that people should look out for as they're thinking about entering one?
Yeah, get everyone's kids' information, so if they fuck you, you can not. No, I would say there are tons of downsides for joint ventures, right? We all know what they are. You don't get along. It doesn't. I would say you want to just be careful, tread lightly around any situation, right? If you're, on a contracting side, right, they are your partner, believe it or not. It may not seem that way sometimes, but you have to manage that relationship. So you want to understand who they are, what they've done. Is this something they can do? It goes for your partner as well. If we're both signing a loan and I find out that you're doing something illegal, my ass is on the line. So you want to know, you don't give me your social security and your mother's maiden name, right? You're not going to get that. But you do want to know who you're doing business with,
You come
right?
close, though. You come close.
You come pretty damn close. You definitely do. You want to know who you're doing business with. But bottom line, you want to know who they are, what they represent, what their values are. I think that's the biggest thing in the world. If that doesn't mesh, you're starting off on a wrong foot. So I would say by far understanding who everybody is, and what their role is going to be. That's the thing. But there's definitely downsides for sure. I mean, we've done partnerships. And people sitting here know it. We have miserable investors in the deals. I would recommend nobody to work with them. That's just the nature of the beast. When you do a lot of deals, and we have 200 plus investors, some people are going to fall through the cracks. But I got an email from one today. He's just I don't know what he's reading. He's reading the wrong information. And I'm brutally honest, and I will trash you. And you may be sitting here and I'm ripping on you, but I'm not bashful, right? Who cares, right? If you don't like me, that's fine. No, so you want to understand who everybody is, whether it's an investor, whether it's your legal, whether it's your CPA, contractor, property manager. One of our property managers went on a racist tirade. It's on the news. We fired him right before he did that, thank God. But who would have known? But you just want to know who people are and what they believe, and you want to dig for sure.
Yeah, absolutely. And I would say just one of the things that, just like the question that you asked me before, why aren't you guys a full company? Mm-hmm. So sometimes some of the things with joint ventures is there could be confusion with your investors, like, okay, who's this company and who's that company? Mm-hmm. We have to answer those questions all the time. Sometimes that happens when I bring my investors to the table. They're reading the operating agreement and they're like, okay, but who is that? And it's like, oh, that's Krista. Oh, that's Chris. I was like, oh, okay, I know who they are now. So sometimes you have to clarify things for people if they don't exactly know. And that can be a little bit, it could be a little challenging, but it's something that easily to overcome. I think overall, though, there are probably a few more upsides to the joint venture than forming a company with somebody right away, if that's the comparison.
Oh, for sure.
And again, I just can't emphasize enough the flexibility that it allows you when you're coming together with
what about
else.
JV versus just doing it by yourself?
Definitely, I would say JV versus doing it by yourself. And again, it really depends. It depends on you. So maybe you're the type of person, you have $10 million. You're able to just, buy a whole bunch of properties.
I think that's everyone here, right?
Yeah, that's everybody here, of course. And, you don't need to work with anybody else because you'll just fund all the properties on your own. But for people like myself and my JV partners, we are looking to build a business together. We find a lot of value in collaborating with each other because while we have different skill sets, we have a core value that's the same, and then we're able to build on that. And we've done really well. So
Yeah, I think so. 100%. You want to understand that going in. That's just the bottom line. You just want to know what everyone's about, what everything's about. If there's not value, if someone doesn't bring value out of the box, I wouldn't dismiss it. But if you're not bringing value to each other, I would probably recommend, diving into bed with each other. Crawl before you walk. But bringing value to the table and adding something that they may not have. Right? If you have a $10 million balance sheet, you're going to provide a ton of value for people. But if you bring that to the table, but you have other baggage, that value may not be worth it. Right. So whoever you're working with, just make sure each person's bringing value to the table, and that might not be, I may do 5% of the work, but I have 85% of the value. Right? That's the balance that you have to figure out with whoever you're working for, because it doesn't have to be 50-50 to provide value. Right? Someone may just be a really good underwriter. What's that worth? That's for you guys to decide together. But if you're not good at that, then I would recommend bringing someone in or finding someone that can help you get better, because the value is what you need. If you bring value to the table, it'll work. If you don't bring value to the table, think twice before you do it, because you will regret it. Maybe not today, because you guys have the same stories and everything works, but if there's no value exchanging, 5 years down the road, 2 years down the road, 2 months down the road, you may be singing a totally different tune.
I think I'm going to steal one last question because it segues really good with that. Let's say I'm somebody who doesn't have a big balance sheet, someone who doesn't have a ton of expertise. Maybe I don't have the ability to raise a ton of money, but I am somewhat educated, or I really want to get into real estate and I really want to partner with somebody and bring some value, but I'm not really sure what value I can bring yet. What are things that people can do that are valuable, or services somebody can provide, or take it wherever you want? Is there anything off the top of your head you can think of that maybe somebody can help do in something somebody may not think of right away?
For us, we are opportunistic. Everybody sitting here, if you brought us an opportunity, it could be the wildest idea. If you bring us something to the table, we'll have a conversation. So I think that, if you don't know what you're doing whatsoever and you don't know where that value is, you got to try, right? One thing I can promise to everybody sitting here, if you don't do it, do anything, whether it's pick up the phone and call a broker, or pick up the phone and call an owner, or send out a direct mailer. If you don't do something, you're not going to wake up tomorrow with this beautiful deal in your mailbox. You go to the front door and they're just like, a 200-unit complex. It's just beautiful. So if you do come across that from doing something, bring it to someone's attention. That's value. Or maybe you have, an uncle that's been dying to, lend money, or maybe he wants to invest. Try something. That in itself is value. And then, you bring it to someone's attention, whether it's myself, whether it's Sonya, Chris, or anyone in here. If you bring something to someone's attention, they say, oh, wow, yeah, let's do something together. I'll give you X. Now it's 100% on your shoulders to negotiate what you think is fair. If you don't think that's fair with that person, bring it to someone else's attention. And that could be, money, underwriting, deals. Maybe you have a really good insight on a market. It's just bringing something to the table. And that could be anything. It doesn't have to be, I have $1 million. I have $20 million. That's great. But, to us right now, where we are and our investors and what we're doing, someone could walk into our office with $100 million ready to write us a check. We are going to vet you. Doesn't matter. And we would say no. We would turn it down, because there's no, it doesn't matter how much money you have, because sometimes it comes with baggage. So it's not always about the money. It's not always about the deal. It's more about, what are you bringing to the table that there's an opportunity to uncover. That's more important. So, the biggest thing for us is bringing something to the table that we can execute on that we would not otherwise have had without you coming to the table.
Yeah, I think that makes 100% sense. And I would definitely agree with that. And I would say that, you have to, it's always about taking the initiative. So whatever it is that you're doing, and just like you said, it may be that you're able to get more information on a market, or you may know somebody who who has insight into, a particular area that is up and coming, or maybe you have some additional information. Information is very valuable.
Yep.
So you may have information that other people, just that we otherwise may not have had because of a relationship that you have. That can be really helpful, and that can lead to other deals. So, don't be afraid also to speak up and to talk to people about what it is that you think you can bring to the table.
Yeah, I think other things too is just being more creative. People are good at a lot of things, and different people have different needs. You may be an accountant and very good at bookkeeping, and we just have no desire to do the bookkeeping. So maybe that's a service you could provide, whether it's free, cut rate, or you partner on the deal. It could be part of the service. It could be something, technology related. Maybe you're in IT and you can help set up some back office software or something of that nature that they wouldn't otherwise be able to do on their own, or they don't have the money to pay somebody else to do, and you can offer something competitive that way. Or maybe you're a contractor and you're looking to get into the flipping business, and instead of taking, being a fee contractor, you do everything for cost and split profits a certain way. Or vice versa. Maybe you find a contractor and you're the one who'll find the deal and manage the money and raise the money, and and you can partner things that way. So I think your partnerships and your value is only as creative as you're willing to be, and finding out what you're good at today or what things you can do today to then go out and bring to somebody else. Maybe you're a college student and you're off for the summer. You can go drive 10 hours a day through different neighborhoods and find all the houses in the summer with grass up to here. Those are great houses to buy to try to flip. That means somebody's not taking care of it. That's tremendously valuable. I don't want to drive for 10 hours. I'm in there underwriting deals and trying to find money to do these, deals and properties. I don't have time to drive 10 hours. But if you're willing to go drive for free, or, a small fee, whatever you work out, that's extremely valuable. So, I think when you're looking to bring value or enter a joint venture or partnership or things of that nature, and you don't have the traditional things that everybody talks about: deals, money, experience, balance sheet. I do think there are other ways. I just think it's going to be harder to find the person, the peg that fits the hole. So you're going to have to try more people to find the person that will say yes and try it out. If you came to us and said, hey, I'll drive 8 hours for properties on Long Island, I'd say, that's great, but you're going to waste both our times because I'm never going to buy one of them. So I would be, the wrong person to go to. But there's probably 5 or 6 people in here that have money and are looking to flip homes that you could offer that to, and they might be willing to take you up on it, or they may say no because they're they have too many deals in their pipeline already, so they couldn't take on the extra workload, so it wouldn't be the right fit. So being creative and finding what you're good at and you can bring to might be very different from the real estate aspect. Like I said, IT services, bookkeeping, could be website building, it could be social media, it could be a million things, but you're only limited by your creativity and figuring out what you're good at. So what we'll do now, if anybody has questions, raise your hand, say it, I'm going to repeat it, and then we'll take turns answering it. So if anybody has a question, fire away.
With the market the way it is right now, how do you compete against more established groups? How do you compete against Wall Street? How do you compete against other groups that use a different matrix?
Mm-hmm.
They're not looking for 7, 8, 9, 10% return on their investment.
Mm-hmm.
How do you not getting outbid every time you're trying to buy a property, especially in the primary or secondary market?
Mm-hmm. So question was, how do we stay competitive against significantly larger players who may have lower return expectations or other resources that us or somebody else may not have?
From our standpoint, discipline. It's July 24th, I believe. We haven't bought a deal this year. The only deals we bought were deals we started looking at and went to contract in November of last year. So how are we competing? We're not. Doesn't mean the dominoes aren't going to fall. The only thing you can do is offer on more deals, underwrite more deals, and, back to Chris's creativity, see if you can do something creative, right? That's it. The easy answer is just pay more money. but you're not going to hit your return. So if you need to make 7, 8, 9, 10, 12%, and the deal's underwriting to 6, it's not going to work, right? Don't try and make it work. Move on to the next one. And then the other thing that I think is the biggest thing that nobody does, we just did it the other day. Every deal that you're not competing on, set a reminder in your phone 3 months to follow up, because I guarantee you that a large majority of those deals are falling apart, and they're not closing because deals are, we have a property people are throwing stupid offers out on, and yeah, sure, we'll sell it, right? But they don't get to the finish line. So if you're not competing, if you're making 100 offers, make 200. And then follow up on 200, because I promise you those deals are not going to close. We are looking at a deal right now in Jacksonville, probably makes sense at 65 to 70 a door, maybe 72. We got 2 separate brokers collectively today sending us that deal at 90 a door. Now we're talking directly to the owner. So the owner negotiating a deal with us, and we bought 2 of his other properties already. So he knows we're going to close. We're not going to pay him 90. Both brokers say like, oh, he wants 90 a door. What is he telling you? And I'm like, they're just throwing shit against the wall, bottom line. So, that guy, whether it closes or not, keep making offers, right? If a deal gets listed over here, to be competitive, call the 10 properties around it, right? Do something different. Just, think outside the box, because you're right. There are huge groups. There's more new investors now than ever before, right? We're competing with you guys sitting in the audience, and I have this conversation with brokers every day now. Who are the last 5 buyers you sold a property to? New investor, dummy from California. Okay. Not that that's a problem from California, right? California's great, but expectations are up. New York's new law with the rent stabilization, right? Go compete with every group in New York that will not, there are huge groups that just pulled all their renovations in New York. They waved the towel and, fuck this. We're not going to make money here anymore. But they're buying deals at 3 caps. They would gladly take a 4 or 5 cap in a tertiary, secondary, a primary market outside of New York. You're never going to compete with them. Yeah. The other way to compete, look at the last 5 years of transactions. Look for first-time buyers that may be in distress because they did something they shouldn't have done. They bought a coaching program from someone that doesn't know what they're doing. They went out and executed on something that they don't know what they're doing, and now they've messed it up beyond belief, right? Those are deals to go target. Every time I see someone new buying a deal, I just circle it on the calendar to say, okay, like there's a deal in Jacksonville right now selling for $19 million. They've never owned in Jacksonville. We have 1,000 units in Jacksonville. Our offer maxed out was 17. Unless they know something that nobody does, there's a huge discrepancy there. So you can't get disappointed if deals aren't happening and you're not competing. You just got to think different, try and get creative, and or follow up, or just make more offers. Yeah. That's the only thing that I would say.
Yeah, no, I 100% agree with that. And, other relationships that you can tap into if you have relationships with lenders in the area, who may have lent on these properties that are not doing well. They may know that the properties are not doing well. You can tap into them as a source of a new deal, of a contact with with those potential sellers. Also, your property manager could also be someone else who can help you while they may be working to help the property go well. Maybe they know, like, look, this is not really cash flowing. The owner doesn't have any more money. This is not going anywhere. And then they're third party only, so they're not going to buy it themselves. They may be willing to make that introduction for you as well.
Yeah, get creative. You call CPAs, right? Any of your clients getting older looking to retire. Yeah. Call estate lawyers, right? Do something different. Don't just call a broker and say, send me your deal. Because he's going to send you the deal that 20 locals or 20 experienced guys already passed on. So just be a little different.
Yeah, I think I agree 100% with what they said. Just to play devil's advocate a little bit, the market is the market, right? If more people are willing to pay X, just because you don't think it's worth X, the market's changed. So you've got to adapt with the market. So that might be going into a new asset class. It might be going into a secondary, tertiary instead of a primary if you have certain return goals you want. There's no fighting the market. Brokers aren't selling deals super high because they're such great salesmen. It's because there's a ton of interest on these properties now. and there's a ton of money because there's low unemployment, high wage growth. We're in a, closer probably to the top of, the economy than the bottom. People have money that they want to dispose of. When there's a lot of supply, demand goes down, so your returns are going to come down. So it's just a function of also the market. So you really have to look at, can I afford to take a little bit less, or can I afford to wait a few years until the market adjusts and corrects? I may want to buy a 7-cap multifamily deal in Florida like you could in the 90s. It's just not happening anymore. It doesn't exist. So I can't complain, because complaining is not going to do anything about it. And I'm not, saying you're complaining at all by any means. I just can't do that. I have to adjust and figure something else out. It could be what they said, or it could just be understanding that the market is different now and expectations have changed, and just being okay with that, or like they said, adjusting and getting creative. So if you can understand that, understanding that there's no changing it, you've got to go on the offensive instead of the defensive and really figure out, what can I do now, instead of looking at it and saying, well, I can't compete. Cap rates are too low. I can't hit the returns I want. Don't play defensive, get offensive, and, try to find creative ways to get around it. That would be my answer to that.
And we've just done a whole new initiative in educating our investors. The days where we were given 30s and 40s, we may hit that, but we've gone to everybody and said, here are the last 15 transactions, right? People are underwriting to 12s and 13s. So where we used to underwrite to 20, 25, a 15 is a good deal. Like, would anyone, if you were getting 30 for the last 5 years, if someone showed you a 15, you'd be like, whatever. But would anyone complain if I gave you 15, right? Like, it's a great deal. So just, understand that, right? And if you can educate your investors and let them know what's going on, now you will be competitive, because the market's changed. He's 100% right.
Yep, that's true.
Thank you.
No problem.
Kevin, you had a question, right?
Yeah, my question from before was just going back to the JV discussion. Having had some joint ventures, whether they went south or, east or west, or they didn't go up. Having had that experience, what are some things that you can account for, maybe putting things in a contract, or, just something that you could do to prevent that for yourself?
Yeah, great question. So just to repeat, the question was, having had some joint ventures that have not gone 100% according to plan, is there anything you see that can be done prior to, whether it's contracts or other agreements or things of that nature beforehand, that might be able to prevent, some of the misalignment that you see happening sometimes with joint ventures?
Yeah, I think one of the things that I would do is I would maybe do like a retroactively look at those arrangements. Why didn't they work? What were the things that went awry? Was it a misalignment of goals? Was it whatever it was? I would say, if you maybe think back on what those things are, and then try to figure out how you can circumvent them going forward. And it really kind of depends on what it is that you felt may have caused the misdirection of the partnership. But I know that, for example, if the situation was, you were working with somebody who constantly, like, you had predefined roles and this person never delivered. Those are hard things it's hard to find those things out right away. You can try to understand people's work ethic and see how they work. But, at the end of the day, they're going to do what they do, like, once you start working with them, and you're not really going to find out until later. Like, when you move in with somebody, you just find out, okay, all of a sudden there's this other creepy behavior that I didn't know about because I never saw them before. But it's also kind of part of the process too. The good thing is that you could just, because you're a JV, you can kind of just separate, and then you don't have to work with them again on any other deal other than that one, and maybe try to wrap those deals up quickly so you can move on.
I would say, don't be afraid to say no, right? If you get a weird feeling, let's say you're raising $500,000 and, at the last minute you need a good chunk of that. And an investor says, yeah, I'll give it to you, but at these terms, sometimes it's better off to just pass on the whole thing. So saying no could be the best decision you've ever made. In addition to that, what we spoke about earlier, just really getting to know someone the best you can. Sonya's right. I mean, you can go into a deal where everything worked out. It looked so good out of the box and everything. We were talking about the other day in the car or today. We said, if this worked, it would have been great. It just didn't. Why?
Yeah.
Maybe the people that were in roles could have thought twice about that. Or maybe, whether it's the manager, maybe he's just, his interests don't align with yours and you didn't see that before. So I think it's just, right before you sign documents or sign papers or you're about to close on something, think twice, right? Have one last look at it. Maybe you have someone else completely third party look at it. Hey, cousin Bob, look at that, or take a look at this, right? Have someone else look and say, wait, what's he doing? You're really not going to know going into it because, like Sonya said, I didn't know he did that, right? He didn't execute on anything. Those things you can't prevent. You just gotta go by your gut. Part of real estate, it can make a ton of sense on paper, but if you get there and something's off, probably don't buy that deal, no matter how good it sounds on paper. I think sometimes you get blinded by, wow, this could really work and it could be profitable, and you turn the blinders off to some other things that may be an interest. From our standpoint, we've done things that I said, that really would have been a good idea if we were able to execute. Why didn't we execute? This person wasn't good. And you could blame anybody, but in the end, you were the one that made the decision, so you got to blame yourself as well. So you can say, okay, maybe I shouldn't have done that. Or you won't know until you're burned, right? You tell kids all the time, don't touch it, it's hot. They're going to touch it, right? Everyone here has been, 18, 19, 20, 25, and your parents say, don't do it, and we do it. It's just life, right? So I think that the best thing that could happen to you is you get burned by a JV, because then you'll get a tougher skin, and you'll think of other things, right? Your ears will go up next time you wait. That sounds too good to be true. So I think that getting burned is not a bad thing as long as it doesn't cost you a ton of money.
Yeah.
But and even if it does, I mean, I joke about it all the time. Sometimes losing $50,000 is the best deal you're going to do, right? Not that anyone wants to lose it, but you'll know exactly what not to do next time, right? So, you just think twice about it, right? Double check it, think about it, sleep on it. Don't just meet someone at a meetup event and go start a partnership. Bad idea.
Yeah.
That's, it may work, but, think about it, sleep on it. Give it let's think about this for a second. Let's underwrite some deals. You underwrite it, I underwrite it. Let's see how we compare. So I think you just do more due diligence up front. That's what I would recommend from things that haven't worked out 100%.
I think to Sonya's point, if you've had ones that have gone badly already, I think auditing what exactly went wrong could be huge. And I think being completely honest with yourself and figuring out the role you had in it as well, not only their side as well, because I think, like John said, we tend to, as just, human beings, put blame on other people a lot. But if you can really self-evaluate really well and say, hey, what role did I play in this that it didn't work out? And kind of reverse engineering from the other person's side as well, I think could provide a lot of insight. I also think upfront going into it, I think the more brutally honest you can be, the better off you're going to be in 2 years. Because if you are not 100% into it and you tell somebody you're 100% into it, well, in 6 months down the line when you're kind of waning out and they're like, why aren't you pulling your weight anymore? It's going to be a problem. But if you say, hey, look, I'm flipping houses, but I also want to get into multifamily, but I can only really commit 6 hours a week instead of telling somebody 40 hours, it may work for them, it may not. If it doesn't work, then you shouldn't have done that JV. But if you tell somebody I can do more, it's never going to work. So if you can be super brutally honest and try to get the other person to also be brutally honest, it will probably prevent a lot of things in the future and will make saying no significantly clearer earlier on. The other part is, too, it's, just like they were kind of saying with dating and marriage, it's kind of by trial and error, right? Most people don't marry the first person they end up dating. You date several people, and some you end up living with and move out because you'll learn something new, and some go the distance. So it is a little bit, you're not really going to know until you jump into bed together, and, you've got to be willing to take that step at some point. All three of us, and well, Sonya, I don't know if have you ever had any poor joint ventures that have gone south, or you've been one of the lucky ones?
been lucky so far.
Oh, okay, well, yours is coming then. But I think some people, John and I, and some people in this room, have had joint ventures that have gone south. We're all here still standing. We're not in the worst situations in the world. So, just at some point you've got to try. And, a joint venture like, Sonya said, is super flexible. It's significantly easier to get out of. So it is a great trial period. If it doesn't go great, okay, great. If you have the roles and responsibilities outlined beforehand, you can continue to operate and coexist and just not really interact as much as you would have liked, and just kind of get through it and then move on. So there is only so much you can do. I do think the roles and responsibilities up front is huge. I do think being super, super, super honest up front will solve a lot of that as well.
Don't be greedy also.
That too.
That's a good one.
John, a second first.
So, what did your first joint venture look like, and what value did you bring to the table?
So for me, it was myself and my JV partner, Krista. So Krista she's an attorney. And we still joint venture on the deals together. She's an attorney. I'm an accountant. It was a really good pairing because again, we kind of started off with that base of the values that we had and we shared, and we have that also with Chris, our other partner, and it really. Those were like the things that really helped us solidify us, the fact that we had those values, and then what complemented each other. We complemented each other's skill set. I think those are the things that really worked well and still work well.
From my standpoint, I just did stuff that people wouldn't. I did a lot of cold calling. I did a lot of direct mail. So I was able to find deals that weren't on market or were not generally solicited. So I brought a deal that you would not have access to. But that came from my background. I just cold called and sent out a lot of mailers. So I had a deal that if you wanted it, you had to go through me.
For me, the first one was me, my mom, and my cousin. And the truth is not a whole lot. It was they kind of forced me into it. But it ended up being a good thing. In truth, it was obviously, we were all just kind of willing to split roles and responsibilities. I think a more useful example for everybody was probably when the three of us and John partnered on the deal in Jacksonville. My mom was one of the balance sheet partners. My cousin helped with the equity raising, the insurance, sourcing the debt, things of that nature. And my role was more of going to be the operational side going forward. So, the biweekly calls, the investor updates, the investor relations, keeping up to date with brokers, evaluating it as it goes on. It just so happened to now then coincide and lead into working at Toro. So it actually ended up being the right role at the right time. But at the time, that was kind of the role I was going to take on, was going forward in the future. And John was also, able to help out with the equity raising, the balance sheet, and the expertise. And, we all kind of had our little parts to play.
So for you guys doing syndication deals, do the limited partners look at it as a partnership? And for those ones that do, how do you guys cultivate that relationship to make them feel like partners?
So it was for in syndications, do limited partners view it as a partnership? And if so, how do you go about, explaining the partnership? How do they view it? Things of that nature.
And just to clarify, are you asking whether the limited partners think that they're partners, or do they think that the JV partners are?
Do they themselves feel like partners in deals when they invest? How it passes?
Well, I think when a limited partner comes on, they're looking at us to run the deal for them. They're looking at us to actually for them to be passive investors in the deal, and the expectations that they have of us are, it's what we set up for them, because we tell them what's going to happen during the deal. So it's going to be, we're going to have quarterly webinars to give them updates. We are going to be, distributing the funds over like certain periods of time, whether it be twice a year or quarterly, et cetera. So we tell them up front what they should expect from us. They're going to get their tax statements by at a certain period of time, and we keep them updated on that. So I don't think that they feel like they're managing the deal because they're looking to us to do that for them to drive the performance for the property. But I think they're looking to us to keep them updated and informed, and that's what we do.
Yeah, we've gone the full gamut. We've had our limiteds not actively involved, but like they can listen into conference calls, so they feel like they're part of it. And that's Michael Kors family office. Like he just wanted to not him, but the nephew was the point of contact. He just wants to listen to the calls, and he felt really good about that. I think he's listened to one of the calls. He just there's the one, he loved it. He texted me, he's like, "Oh, this is fantastic, thank you." But then again, some of the worst deals we've done is given our limiteds too much pride, right? They just got in the way. So I think that comes down to who you are and who your investors are. There's nothing wrong with limiteds asking questions and being involved, but sometimes that involvement makes it a lot more frustrating because they're not involved. They don't understand. So if you explain how the process is going to go and they buy into it, like we have investors that write checks and we don't hear from them all year. They don't care. They're just, that's what they wanted to do. They're brokers, they're accountants, they're lawyers. They do that. They just want an alternative investment. I'm not saying to look for those people because that's great. It just depends on who your investors are going to be. There's nothing wrong with involving your investors and having them feel like it's part of the deal. Just understand that could also backfire brutally. So do our investors feel like they're part of it? Some of them do, and then some of them don't want to. So I think it depends on who your investors are and how you want to go about it out of the box, right? You got to set your precedent here. Yeah. You got to set your rules. And if they don't want to play by your rules, it's on your shoulders to either make an amendment and let them do what they want to do and involve them, or say, hey, maybe this isn't going to work because, this is what we're looking for. So I would say that's very important.
I think limited partnership, limited partners is obviously a form of a partnership, but it's not in the true sense of a word an equal partnership or, somewhat higher or lower. It is a limited partnership. How much leeway you give them is up to you. But I think if you want, if somebody really wants to be, a more active partner in the deal, that's why there's something called a general partner. They're on the GP side where they're more active. They have roles and responsibilities. But a GP is a very similar thing to a joint venture. You could almost use them synonymously. It's just when you start getting into the world of having limited partners where you're raising money from other people, it's just easy to distinguish between the limited partner and the general partner. So start to kind of blend the boundary between limited partner and the JV world. And like they were saying, you don't want to have, give people too much say if they're not involved in, the realm or the world. But if you have someone that really wants to be active, they want to contribute a lot and do other things, they may not be a limited partner. They might be a general partner.
We had a ground up construction deal where we would get calls, why is there no cash flow?
Yeah.
I don't know, because there's a hole in the ground. Like, don't know who's going to pay for that. But they just had no idea. They were just completely clueless to what they were investing in. It was a crowd-funded deal, good, bad, or indifferent. But we would have multiple calls of, you haven't distributed money this year. I'm like, okay. So just you want to know who they are, what they're looking for, and you want to just understand. Now, that's not a bad question per se if it was like a one-off. But when you call like 7 months in a row, that's a bad question at that point.
If you're raising money, small amounts of money from multiple partners, what do you think is the best partnership structure in terms of ease of getting financing?
Mm-hmm. Right, so the question was, if you're raising, small amounts of money or a small total amount of money, what's the best type of partnership structure, especially as it relates to getting financing?
So I think the first question, this probably doesn't help you, but the type of financing you're looking for will probably help back you into that structure. If you're raising 200 grand and you have 87 investors, that's going to be difficult.
Yeah.
If you have like 4 or 5 investors, 50, 75 pop.
Yeah.
Like that, not something like
Yeah,
85,
as
friends and family type of money.
Yeah, so a regular structure, you don't have to worry. As long as no one owns more than 20% of the deal, you typically won't have to provide financials, or they don't have to sign on the loan, or they don't have to be key principals, as long as they're less than 20%. So if you're going that route, if someone wants to put in more than 20%, let them know that they may have to be looked at by the bank. On the flip side, if they're looking for equity partnership or a debt partnership, right? If you create, JC Co. 1, they can lend you the money, and then you can go get the loan, and that money is your money in a debt instrument. If they want to be equity partners, it depends on the bank. The bank is going to be the dictating factor behind that, but knowing who your bank is and who you want to work with, then you can back into a structure. So I can't say this is the best way to do it, because it depends on what you're looking to accomplish. If you're looking to fix and flip houses, there's 100 structures you can do. If you're going to buy multifamily, it's going to be a different structure. So I think it depends on what you're looking to accomplish. Yeah, so as long as no one owns 20% of the deal and it's a non-recourse loan, you shouldn't have any issues. So as long as you're raising $500,000, if no one owns, if no one has $100,000 investment or more, they invest in an LLC, you're the general partner, not gonna have an issue, for the most part.
Yeah, that's right. Yep.
Are there any clear advantages to joint venture versus just a regular general partnership in terms of getting lending or tax purposes or liability or anything like that?
Question was, is there any benefits to doing a joint venture versus a general partnership agreement in terms of anything? Is it financing? Is it liability agreements, things of that nature?
Well, the bank is still going to want you to have one entity that the property is under. So they're going to still require that you set up, more than likely, an LLC that is going to be they call it like a single purpose entity for that property. And then all of the investors are going to be investing in there, and you're as the general partner, you're going to be you'll be managing that LLC. So that's like the typical structure that banks are expecting. But just to the point that John made earlier, if you have people that invest over like that 20% amount, the bank will want to, what they call, underwrite them. They'll want to review their financial statements. They'll want to run their credit. As a sponsor of the deal, that is expected of you. They will want to do that for you and all of the people who are the sponsors. But if you have investors that have large amounts of an investment in the deal, they'll want to look at them as well. So I'd say it's probably more of a trigger of the amount of the investment that's going to cause potentially a longer process, because there'll be more people involved in the bank review.
I would say the only benefit, and this is just thinking outside the box, if you have a bad credit score and or you don't have good liquidity, your JV agreement could be over here and your single purpose entity is over here. You can structure this different than your agreement with your partner. So maybe you don't have to sign on the loan, or you don't have to, but you're still going to get part of the upside as if you were on the general partnership. So a JV agreement could supersede this one, which could help, if you had a bad credit score, if you weren't liquid, if you hurt the chances of a loan. But as long as you're not hurting the loan, it doesn't matter either way. It doesn't matter, because every deal a bank's going to require you open a brand new LLC on the multifamily side.
Yeah.
All right, awesome. I think we'll cut it there anyway, even if there's more questions. It's after 9 now. But just wanted to say thank you to Sonya for coming. This was great.
you.
Thank you for giving your expertise. If you guys want to get a hold of her afterwards, I will send out an email through Meetup that has her information. When the video gets put up on YouTube, it'll have it there as well. It'll also be my email. I'll provide John's contact information, but we'll be around for the next half an hour, depending upon who's got what going on and where they're going. So please feel free to come up, introduce yourself if you've not met, come say hello if we've known each other far too long now, and just use this time to network, and feel free to leave when you please. We got the room for the next hour or two. So that's it. Thanks for coming, guys.
Thank you.